So here we are, Sean, at the beginning of July. I can see in the background the tennis is on. It's Wimbledon season. Another quarter has been and gone in the markets. And for me, it feels like there's a real battle going on between the markets trying to, go with some momentum, and yet they're being held back, or there's a counterforce going on, which seems to be a much bigger issue more globally. Just, how has things been over the last quarter? Give us your sense.
Yeah, Q2 was the strongest period for global equities since COVID. We had the S&P 500 was up 14%, NASDAQ was up 25%. A lot of this was isolated to kind of like tech. It's the AI narrative continuing on. More specifically, it was the memory space this time around. Things like the South Korean Kospi, that index was up 70% in a quarter, largely because of two memory stocks, SK Hynix and Samsung, which make up 50% of that index, doing phenomenally well. And yeah, there's a lot of strength, but then you contrast that with the ongoing conflict with the US and Iran. That was a consistent back and forth between the idea of peace deals being made to then renewed attacks. And I think the volatility that caused, and also the forward pathway of how is this going to impact, energy prices, how is this going to impact inflation, and therefore that all feeding into bonds, yields, and interest rate expectations. It's been a really interesting dynamic between some serious concerns and some serious positives, between earnings and inflation variables like that. So I do think that it's a time where selectivity and diversification is appropriate.
Okay, so with that all in mind, how are portfolios positioned looking forward? What's your kind of sense? How are you discussing a forward-looking portfolio with clients at the moment?
Yeah, so I think it's okay to be slightly cautious after several consecutive periods of strong growth. I think risk management comes more to the forefront rather than return seeking. We are underweight equities on the whole, but we're more selective in the areas we want to be exposed to. I think there is a case for it's becoming more apparent where losers are and where winners are. So you can be underweight equities, but maintain exposure to where you think the true opportunities are, which is what we've done. And then we've also increased our exposure to alternatives, real assets, commodities. I think these are natural diversifiers against any equity sort of weakness, and obviously, the inflation protection. And bonds, I think, interesting space. Again, sort of weakness with not knowing how to interpret this around conflict, but we remain sort of at level in bonds with some index-linked exposure.
Great. So, there's been good returns so far this year. There's some caution out there, but there's still positive expectations that clients can look forward to. And we'll just see how the world develops over the next quarter. But thank you very much.
Thank you.